the thing you have to understand, the Federal Reserve is going to focus not only on inflation, but also not tightening too fast that will create a recessionary environment, which is already starting to be talked about right now. You know, I was online with one of these Reddit board kind of things that people really go crazy talking about, and they're speculating what they think is going to happen, what's going to happen with the Fed, what's going to happen with inflation. Here's, I think, what's going to happen. Fed's going to let inflation run, try to catch up intentionally so it doesn't put us back into a double-dip recession. I think that's what's going to happen.
Michael, I've warned you about going down the Reddit wormhole with a glass of wine in your hand previously. It's not a good place to be. By the way, I don't know you had a glass of wine.
But let me just tell you, I'm not going down the Reddit hole. I have a friend of mine who actually told me about it. I looked online. Okay. Crazy stuff that's being written.
Just a friend.
But, the reality
Michael, that's fine. just a friend. Okay, look, in terms of this inversion as well, and what everyone's going on about, obviously the 210 and the other points on the curve as well, when you've got a central bank that has just basically hoovered up most of the bonds available at one point as well, is the inversion on the yield curve actually worth looking at these days?
I don't think it's really a big deal right now because the inversion on the yield curve is really based on speculation that the economy is going to be soft later. And what we really have right now is, I think, an anomaly of inflation because of the lockdown and really the spring back of economic growth combined with huge supply chain problems, which continues to be a problem in China as they continue to lock down. So I don't think you can really take the same rules as the past and layer them on top of an unprecedented situation that we hadn't experienced since the Spanish flu 100 years ago. I think that's the mistake people are making right now, making that conclusion.
Michael, what does this mean for investment in equities then in the United States? Because it was a challenging first quarter here, and it just fits into that narrative that the markets are fundamentally shifting their view on what they expect returns will look like for this year. And yet we know April traditionally is a pretty good month for stocks and a dangerous time to be too aggressively short of them.
Yeah. You know, I think that a couple things. I think that the bottom that we've seen lately in equity markets, I would not be surprised to see this is where the resistance sits. And you're going to see markets really bump up against that resistance because I think you're already starting to see pricing in of higher oil prices, higher inflation, lower corporate profits. And I think that absolutely is going to impact investor sentiment right now. But I think, again, once the economy starts to open up, and believe it or not, once oil prices start to drop, when things start to calm down between Russia and Ukraine, I think you're going to see more of a normalization in terms of stock earnings. So I wouldn't be surprised to see upside surprises in the second half of this year.